I do like to start off the show each week with a summary of kind of what I saw happening in the stock market this week. And again, this is the sixth week in a row. It's kind of fun doing the show when it's up
Hmm.
week after
Yep.
week. Uh, and there's a couple things that are happening that are quite important in my opinion. First of all, we have October 13th was the low point in 2022. So we just had our 2-year anniversary. So
Hmm.
we'll talk about the significance of that. Uh, and what we talk about is the primary direction. So the primary direction is still up, that's for sure. And then the other thing that I think is quite interesting also, just looking back for the past 12 months, October 27th was the low of last year. No, well, not the low of last year per se, but that big drop that happened
Hmm.
during the summer. And we've had quite a nice run. We had a 5% drop in April, 8.5% drop in August, I think a 6% drop in September, all of which recovered very quickly. You can see those. I would call those V recoveries, right?
Yeah.
Instead of that kind of long recovery that we call U recovery. V recoveries are a sign of a very strong market. It takes a week or two or three to come all the way back to whatever it is that was lost. Most of the downturns in the last 12 months have come around concerns about slowing in the economy, mainly the job market,
Hmm.
because we saw unemployment pick up a little bit and those types of things. And that has, continued to get a little better, probably within reason as far as that goes. And we're seeing more and more reports that are coming out showing that the economy is maybe pretty far away from a recession,
Yeah. It
right?
might be slowing down, but it's still a strong economy.
Yeah, I mean this week, for example, yesterday market was up during the day. We had some good reports, earning reports from Netflix, from Taiwan Semiconductor, which
Hmm.
we can talk about semiconductors because that's been a big area right now too. But and so the market's up in the morning, and then all of a sudden they come out with the retail sales report, which is quite good, better than expected. And the market actually ended up down, 0.02%, but it came
Yeah,
down from
I
where it
think it's
was.
more the market's reevaluating the amount of federal tax or how much the Federal Reserve is going to actually cut interest rates.
Yeah,
And I think every time we get another strong report, they're like, okay, maybe we're only going to get one hike or one cut, or
yeah,
like it's only going to be two quarter cuts.
yeah,
So
yeah.
they're changing their scenarios based on that.
Yeah, because after the last meeting, the September meeting, I think of September 18th, the Fed, cut half a point, and the market was expecting, I think, a 56% chance of another half point rate cut here in November 7th, which is coming up. And now that's disappeared. There's no expectation on the futures market for a 50% 50 point rate cut. It is still in the low 90 percentile bet that there will be one rate cut.
Hmm.
Um, and be quarter point in that case is what they call one rate cut. Now, I think the thing that's interesting though, the numbers keep coming out kind of stronger and stronger. I bet you there's going to be an awful lot of debate about whether they should even do one. I know the market is expecting at this point that they do one, but we've seen unemployment claims get a little better, retail sales, and so we'll see. We're going to get the PCE inflation report that'll come out at the end of the month that they'll be able to see. Of course, we'll get. Do we
I think they might get one more jobs
one more
report.
jobs report just before, right?
Yeah.
That sounds right. And so, the last jobs report was a lot higher than expected,
And they
and so,
revised up previous months that were quite low too.
yeah, exactly. So, if they get another good jobs report along with all these other things, do they not cut rates? Now, long term, I don't think this stuff makes that much difference. That's what I was saying yesterday in the daily video was just that although the market dropped, based on this good retail sales number where good news is bad news, I said ultimately good news in this case, I think is still good news
Hmm.
because a recession is what we're used to damaging the market.
Yeah.
The 2008 downturn and the 2000 downturn, 45% down and 57% down. Those were caused by recessions. And so I think, having a high retail sales is a good thing. It pushes recession farther off.
Yeah, yeah, and even other investment banks also think this. Goldman Sachs trading arm, Scott Rubner, their bank managing director of global marketing and tactical expert, he expects the benchmark or the S&P to end above 6,000 for the end of the year. Historically, from October 15th to the December 31st, has been a 5.17% return,
Average return. Okay.
average return, and then in election years, the median return has been above 7%.
No, that's interesting. So a little over 5 in a normal October 15th to end of year period, and it's a good time of the year. It just has been
Yeah.
always. I always look forward to it. It's the
Oh, it's
holidays and
median, not average, actually.
oh, median.
Yeah.
Okay, and then that jumps up to 7+% in an election year. That kind of jives with my experience, of going through these things. And, it's a pretty good time to be an investor right now. There are things going pretty well. And so, when the retail sales report comes out and it's positive and the market drops, eventually the market's going to catch on and start to move. And it already is today.
Hmm.
We're sitting at an all-time high. If it happens to close there, we'll hit another one. I think that'll be the 46th one this year. And I don't know what much more you can ask for. And this week, one of the things that we did see was quite a heavy rotation into, again, other areas outside of the
Yeah,
Magnificent Seven.
we saw like a lot of flows based on just earning reports.
Yeah.
Financial earnings were good, so we saw a lot flowing into the banking industry.
Yes. Yeah.
If someone player like ASML, which is kind of like they provide the manufacturing for companies that actually do the chip manufacturing, the lasers. They had a bad report, and you could see how the industry reacted poorly to that.
Yeah, there was a pretty big sell-off early in the week in the semiconductor arena because of this ASML, earnings report. And then, Thursday, Taiwan Semiconductor came out, and they're obviously a major player in the semiconductor arena. They had a very good report. They had a very good outlook,
Yeah,
where
and you
things are
could see
going.
like Nvidia and AMD
Yeah.
and the other semiconductors bounce from that.
They all came back pretty strongly. Nvidia had hit, I think, on Thursday a record high, maybe it was Wednesday, a record high itself, and then got knocked down with that ASML report. So, we're in the middle of earnings season, so and it's very important. Earnings are the main driver for the stock market, so it's kind of interesting to see. But you don't get, high earnings from every area. The reason that they're concerned with ASML, it's possibly a leading indicator for,
Mm.
what if these companies are stopping or cutting back on buying these lasers, then maybe they're cutting, having slowdowns, in the front end
Yeah,
also.
and the industry also had kind of some regulation concerns too,
Yes.
with the Biden administration possibly doing export limits on certain AI chips to
To
base.
to certain countries,
Yeah,
basically. Yeah, right.
it's mainly directed at China, but they also want to cover other countries to prevent basically selling to another country and then China importing from that country. So it was a broad amount of countries, I think 40 plus, that was actually thought to be on this list.
I think these import restrictions they're tough to enforce just because there's enough bad actors out there that can funnel things around. I mean, you've read a lot of articles about the restrictions on Russian oil, and Russian oil's still kind of getting out there in different ways. I would imagine Russia's not getting as much as they would have gotten
Yeah.
without the restrictions in terms of dollar per barrel. But I think the part of the reason we're seeing oil sitting in the $70 range, is just because there isn't a massive shortage of it.
Hmm.
Partly maybe because Russian oil is coming out. So you have to wonder with the chips. Yeah, but every time that gets announced, hey, you can't sell to China, or now it's China and other countries, and it's further restrictions. Is basically what they were talking about this week. That takes a chunk out of the semiconductor market for
Yeah,
a
it
little
takes
while.
out, it hurts their revenue and then that hurts their profitability and earnings. And so it kind of was like it's whatever, any restriction slows them down.
And my gut feel is that especially with Nvidia, you read their earnings reports and you look at what they're doing. I mean, they're already inundated with orders. I would think that cutting back some orders could be damaging long term, but right now they've got enough customers that'll buy what they've got. They can't keep up anyway.
Yeah.
So because the foundries like the Taiwan Semiconductor that are making some of these chips, it takes time. If there's a massive explosion in demand, you've got these very large machines, and very expensive machines to
It
put in
takes
place,
time. You
right?
can see with Intel, who's been struggling because their foundry is taking more money and more time than expected to get up and running.
Yeah, there's a surprise. So let's talk about some of the history of these running markets like this. So this is what's called a bull market. So bull market means the market is going up, the primary direction is up. A bear market, the market's going down, right? So let's look at the history of the bull market. So this came out, and maybe, yeah, there we go. This came out, again, this is a little bit hard to see, apologize, but you can look at the little blue bars there. This is every bull market going back to 1949, okay? And so you look right now, we just hit 2-year anniversary. And there, if we go back a ways here, 1966, there was a 2-year, run. 1970 was a 2-year run. That was during that high inflationary time period, much higher than what we have now. No pandemic, to push things with, the high retail sales, I still think is somewhat related to this kind of, pent up demand that's still coming out of this, pandemic and the money that people have. But you've got a 12.3 year run in 1987 to 2000, 11-year run from 2009 to 2020. And so one thing to keep in mind is that the average bull market or up market is 5.5 years in this time frame. So we're at 2 years. Again, there are some that stopped in 2 years, so it's possible. But the average is there, 5.5. And then the average rate of return during that 5-year period is roughly 180%, and we are at 60%, give or take, right? So there's some room potentially on an average basis to continue this run. And I think it's super important to kind of understand that. Now, also one thing I think is fascinating is that over a period of time here, they've been able to use things like quantitative easing, the interest rate reductions down to zero, and we've been able to shorten some of these, recessions in terms of at least time, especially starting in 2008, because a lot of this stuff came at the bottom of that market that we're using now. And so the Treasury and the Federal Reserve have these tools that they really haven't used before, and those tools can allow the market to continue running. Personally, I think there's some danger in those tools, right? Because we're kind of flooding the market, to be able to make this happen, the number of dollars getting printed and those types of things. However, as long as we can sell our treasury bonds, which we have been able to do quite nicely, and we can especially sell them during times of stress. I think this is super important to understand. When you're going to do these fiscal stimulus things, you're going to send money out to people's households. You're going to, do quantitative easing and buying bonds, like the Federal Reserve does on the open market. You have to be able to finance that through the sale of bonds. And the times that we would need to do this the most are the times where things are really falling apart.
And that's when investors tend to run scared or have fears, and they run to treasuries.
And they run to the U.S. So I've said for a while that, if you look at, first of all, looking since the pandemic, the U.S. has had the greatest recovery out of the pandemic. China is struggling. They had all kinds of issues with how they handled the pandemic to a certain degree. And so they're still kind of behind. I think they eventually emerge from that and do quite well. But it's going to, there's a lag there. I mentioned before, I'm really glad that lag was there, because if China was hot like the U.S. is hot, we'd still have an inflationary issue, I believe. I think China is struggling a little bit here, and they're actually having a deflationary issue in the country itself. Kind of keeps things going, and then maybe when the rest of the developed world starts to slow down, China starts catching its legs, and they kind of keep us out of a recession. So that's something that I've been looking at for quite a while. But when you look at kind of what's going on in these markets, I don't see, anything that says to me at this point in time that this bull market can't continue, right? And so anything can happen. I've mentioned before, we didn't expect the pandemic. As a matter of fact, if you go back and look at the chart prior to the pandemic, matter of fact, here it is. We had a big drop. If you look, that first drop, that big drop that's on the chart here, on my side, that was a 20% drop at the end of 2018. And that had to do with the raising tariffs, and at the same time, the Federal Reserve was raising rates, which is not a good combo. And the market didn't like that. They cut back on the threats of raising tariffs a little bit, and then the Federal Reserve actually started cutting rates, and the market took off. And we were on a really nice path up until the pandemic with that big cliff, right?
Yeah.
So here you are, bull market. gets what was the length of that bull market in the end? It was 2018.
It was 2009.
That was part of that 2009. Okay, yeah, that's right. They didn't actually get the full 20%. I think it was like 19 point something percent. So they don't
Mm,
consider that. That's how you stop a bull market, is drop 20%
from the high to the.
from the high to the low. And I do believe that they didn't consider that, a full bear market. So kept it going. But, we were in the middle of a nice recovery out of that and, the pandemic. And so anything can happen as far as that goes. Keep that in mind. But I still think that there's some good factors here. So one of the things that came up in one of my strategy sessions, a client asked me, well, market's doing great, but what could keep it going,
Mhm.
right? So a couple weeks ago, we discussed a report coming out of UBS about basically what they saw as the potential for another roaring 20s, right? Where we have this kind of big run up. And these are the four mega trends that they saw, which I'll present again because I still think they're important. If you can remember these four when you're thinking about the market, especially if it's suffering a little and coming down 5 or 10%, think about these mega trends because this will help. Again, our object here is the positive, trying to weigh more evenly with the negative that
Mhm.
we all get. So capital spending boom could occur. So one of the things that happened 2020 caused a big capital spending boom as people were all getting settled in
Yeah.
their homes and all this stuff. And so what it did, it kind of consolidated, and we're now, almost 5 years away from that. It consolidated a bunch of capital was, purchased, is now 5 years old, and that tends to be an arena where you start to see that, replacement of that.
Especially as rates come down and people are more willing to spend their capital.
Yeah, that's exactly right. And so that's why rates are so important as far as that goes. And, some of that capital spending is coming in this newish concept of artificial intelligence. We've seen, announcements from, I remember Microsoft was about a couple months ago announced they're going to build a data center with 100 billion that they're spending on that, right? So there are some pieces there. But enormous investment for green energy, right? So one of the things that we realized during the pandemic was that you need to be more self-sufficient,
Yeah,
right?
insulated from other
Yeah,
countries.
and you look at what happened with Russia and Ukraine. Europe looks at that and says, "Hey, we need to be more self-sufficient." And it isn't just trends that would happen here in the U.S. It can happen anywhere and flood that world with money as far as that goes. And of course, deglobalization, which is what I'm talking about with clean energy, isn't just energy. It's semiconductors. It is onshoring different manufacturing that has been shipped overseas
Hmm.
for what, 20, 30 years, is now starting to come back. And that takes a big capital expenditure to do that. And I think it's super important, in terms of the level of types of jobs that you can have, the, security. If we can actually get to a spot where we're making, have some capability of making our own semiconductors, that would be, I think, a really big deal because we've got, I think we have exposure as a world, certainly as a country, having all that done. Now, I read an article saying there's basically 22 steps to, completing a semiconductor, give or take. And because semiconductors are so light, they don't have to be in one place. They can
Yeah.
ship them really easily and move them around. And so here in the U.S., what we're working on with Intel, for example, is still only like 4 or 5 of those steps.
Yeah.
So they're still going to make these things in Intel here in the U.S. and ship them, across the ocean and then back again. And so and again, during the pandemic, we realized that doesn't work very well, right? That movement was difficult. So, we might not ever have another pandemic, but it is still coming on. And of course, the last one is artificial intelligence, and we talked about this big data center and those types of things. So, I do think this is important. I think this is the types of things that can drive the market. If we look at the typical anatomy, right, of a bubble type market, which is what we almost always end up with in the end, you will have kind of these big companies move first because they're safe. So the Magnificent Seven are known for that because they have great cash flow, huge cash positions, dominant markets, right? And then it starts to spread. And so we're seeing a spread right now. We're seeing real estate and utilities and financials and small caps.
Hmm.
And, we're starting to see a bubbling up of some of these other things. So that's normal. That would be part of the anatomy. And then I would expect an IPO market to start taking off because there's been a long time since we've had a good IPO market. And so maybe next year, second half of the year or whatever, we start to see there's a lot of companies probably sitting out there waiting.
Yeah, and so this IPO market will be good at first because
Yep.
it'll be all the companies that have been holding off on their
Yeah.
IPOs.
Yeah.
But eventually the market will get kind of inundated with IPOs. And
Right.
so a bubble is when you have things that shouldn't be IPOing or shouldn't be coming to the market and pushed up, but they're, seen by the market as good.
Yeah, exactly right. So that that's the end of that, piece there is when you start to see the craziness, when you see bingo.com like
Yeah,
I
it will
saw in
be like
2000.
AI or, dot AI next. Yeah.
Yes,
So,
exactly. It will be, and it'll be, and it'll be, if you look at what was happening at the end of the big run in 2008, anybody that could fog a mirror was getting, getting a house. Negatively more amortized loans were, I think, I remember reading an article, it was over 80% of homes selling here in the area were selling with negatively amortized loans. So basically, you pay the minimum payment and your loan, the value of your loan was still growing. You weren't
mhm.
paying enough to make the full payment, but you could qualify for that minimum. More people could. And of course, all of that exploded on us. So those are the types of crazy things that you'll see at the end of these bubbles. But we're like solidly at the end of the first third or something along those lines, at least in my opinion. Now, oftentimes that you can see some slowdown in the actual rates of return. Like the third year tends to be not nearly as good as the first 2 years. Sometimes the fifth year can be that big blow off top. We had 1998. I think the Nasdaq doubled that year
Mhm.
in that particular run. And so it's fun to watch, but at the moment we don't have any of those things, right? Again, if you look at the anatomy of what's happening, if you look at the major factors, that are pushing things, things aren't too bad actually. So, um, and the market concurs with that. We're seeing, new all-time highs on, at least a weekly basis here as far as that goes. So, the record is 77 all-time highs. Somebody asked me that. Now I'm kind of locked in on it.
It's gonna be
I,
tough though.
It'll be a tough one to get to, but I don't know. I'm voting for it. So anyway, that's something to watch for. But thank you for joining us. For this summary. I like to do this each week, so look forward to doing it again next week. And we will be here. So